All investors of cryptocurrency should avoid these 5 taxation mistakes. Because of its substantial volatility in equity and forex markets, cryptocurrency has become increasingly popular among aggressive dealers. Because of its large volatility of equity and forex markets, cryptocurrency or crypto has become more popular among aggressive traders. While there are numerous differing techniques for technical analysis, cryptographic and traditional financial markets differ, mainly in tax calculation and payment. It could be a frustrating, difficult procedure for your crypto taxes to be carried out. This is because the buy, sell and trade of your crypto data is likely to spread through many different platforms and exchanges and all other crypto activities. This is because it is therefore difficult to collect all the data. So understanding the fiscal rules of procurement, sales, trading and earning crypto has never been more critical. Here are the common tax mistakes which should be avoided by any crypto investor. 1. Failure to include previous year's trading experience. Verification that all trade data from previous years have been included is a crucial component of the tax filing process. Many traders make the same mistake that only data from the prior fiscal year are incorporated. That is an intelligible mistake. Why should you upload or include your trading experience from previous years if you only produce 2020 reports? It turns out that it is essential to have your whole trade history. That's because the date you purchased the Bitcoin asset is determined by your cost basis. Suppose you purchased Bitcoin in 2018 and traded it over the years in and from various other exchanges. In such a case, your cost basis for subsequent crypto assets can be difficult to disclose properly without providing the information behind this first purchase. If information is not provided relevant to your crypto active asset cost base calculation, a much larger tax bill can arise. There is a general interest fee, GIC, on your balance when you do not make an early payment. Every day your debt will increase and not be paid. Interest is calculated on the balance due daily and is regularly credited to your account. You can check this Australian crypto tax guide to learn more about paying tax correctly, but other resources are available online if you live in other countries. 2. Crystal received from forks, splits and airdrops not reported. While airdrops, forks and splits may not be familiar to novice crypto monetary investors, it is important that everyone knows them rapidly because of their tax implications in the area. While Bitcoin is technically free, the tax collector surely knows that through airdrops, bifurcations and chain splits many traders that have crypto monetary problems neglect to track forks or airdrops windfall. You will almost certainly face a higher tax rate if you do not classify cryptocurrency gained from airdrops and forks as such. This is another common mistake made by traders who have lost track of what they had because of splits, airdrops, or bifurcations. Assume that you use crypto tax software to automatically create your tax returns. In this case, you must show the software how these tokens have been made. They appear to have been emerged out of slim air on your account or wallet if they are not classified as forked or airdropped. The program will advise you that if you try to trade or sell coins, you will try to sell something you don't own. 3. Crypto not classified as income. You should include the fair market value cryptocurrency in the regular revenue if you were offset in cryptocurrency. Please note that the payments made for service delivery in cryptocurrency are not taxed in the same way as the sales of crypto are maintained for investment use. Anna, for example, worked for the startup and on the 8th of August 2020 was compensated for 1 BTC. 1 Bitcoin was worth $1,000 at the time of receipt. When filing their income tax return 2020-2021, Anna must disclose income of $1,000. In addition, not all transactions related to cryptocurrency are taxable. While capital gains are generally taxed for crypto monetary sales, Crypto monetary generated by mining or paid for work or for services may be taxed as income. It is important for you to identify cryptographs by means of a commercial crypto mining activity as income. If you are unsure of your income, please consult your country's crypto monetary mining and tax guide. You can find out if it is income. 4. Crypto gains and losses not calculated. Although most traders know that cryptocurrency profits are taxed, cryptocurrency losses can be used in certain circumstances to offset their total taxable income. If you suffered a crypto loss, in the current or subsequent years of tax you may be eligible to claim it. Losses can and should be reported, such as profit, and losses could totally annul the tax impacts of profits. If they do, however, the taxpayers still have to make the transactions public. Cryptocurrency investors are not obligated only to declare and pay tax on their earnings, and in determining their tax liabilities they should take account of the gains and losses. 5. Don't file crypto taxes. In terms of tax and cryptocurrencies, this is by far the biggest mistake that people make, and it can be deliberate or accidental. Many fans of cryptography were drawn to government-free digital money. First, although crypto proves hard to trace, crypto traders do not relieve themselves of their tax obligations. It is prudent to file an updated return and make payments as soon as possible if you previously did not pay taxes. If no timely payment is made, the outstanding balance could result in penalties and interest, which may be considerable if tax evasion is discovered years later. Conclusion. It is quite easy to carry out an essential tax report on cryptocurrency for irregular traders. However, you may want to consider using the services of the tax professionals, regardless of whether you are a full-time crypto trader or have carried out several companies in a tax year. This is to ensure you follow an effective tax plan. Suppose that in the past year you traded cryptocurrencies. You will then have to verify that your crypto taxes were properly submitted to prevent overtaxation. If the most acceptable method of crypto tax is not known, then a tax expert with important cryptocurrency assets will give you sound tax advice. We hope you enjoyed watching and listening to this video. Please let us know your opinion in the comments area below. If you found our content useful, please like it and share it with your friends. Also, don't forget to subscribe to our channel and hit the notification bell for more crypto-related contents.